Yeah, the GARP analysis is an interesting one. So, all analysis comes down to really analysing what are the net assets of a company and what are the likely future earnings of that company, and are you buying at a price, number one, that's reasonable, respective to your forecast, and also cheap enough to counter any mistakes you've made in your analysis. And of course there's going to be mistakes. As far as a specific example, I think one which has actually already run, it's one of our top holdings, Challenger Financial. It's already had a good run, but it actually still seems to me to be very good value. If you come down to GARP analysis, the other way of looking at that is using PEG ratios, price to earnings divided by the growth, to say what price am I paying for the growth. We prefer to use enterprise value to EBITDA divided by growth, because enterprise value also tells you the debt you're taking on. So PE only tells you half the story sometimes. So on an enterprise value to growth basis, you've got Challenger enterprise value to EBITDA of around about 9 times. The market's forecasting about 10% growth. We actually think that's probably, the risk is actually they'll get greater growth. The annuity is just, growth is compounding on itself. The banks really aren't competing in the annuity space because of all their other issues and their capital requirements. And the recent budgets actually opened up the door for more and more annuities coming through. And Challenger has no debt. So that's, again, why you look at that enterprise value to EBITDA. So I think the price you're paying for the current growth and the actual risk is on the upside for growth. That's a good example of a stock that, whilst you're not buying it on 5 or 6 or 7 times earnings, you're compensating for that growth. So that's probably the best in the GARP analysis that would be on our books.